You know what gamma is?
Yes, I think gamma is the velocity of the delta.
It's a derivative of the delta, right?
Yeah.
Now, the problem with gamma is almost a useless number to us. To a stock trader, your gamma, if you buy the stock, what's your gamma?
Well, you're accelerating it, so I guess goes up.
No, your gamma is zero on a stock,
Oh, right. Yes.
right? Because
Yeah.
the delta never changes. It's like always the same, right? So in an option position, the delta changes. How much is it going to change? Well, in the next $1 of price movement, it changes $2.08. That's how much it
Mhm.
changes. That has nothing to do with how much it changes in $10 of price movement, right? So if I'm on the index and an index.
Before we get rolling here, just a reminder to please like and share our videos. Your support helps us to continue to bring you the wonderful content that we share with you each and every week.
Moves 50 points in a day, my gamma on the next $1 price movement is almost irrelevant to me.
Right.
Right, because the gamma on my first dollar might be 100, but my gamma on my second one might be -2, right? Or my 10th dollar might be -2. So it almost becomes like a not useful number. You're much better off just to look at the profile of your T+0 line, see what it's doing, right?
Right.
My theta is a theoretical number. You know what the theta is?
Yeah, that's the time decay.
Right, but what does a -31 theta mean?
So it means that we would make $31 because if we are selling that put, for instance, time works for me. So I would make 31 if the
Right.
price movement, if the price movement of one.
Well, with no price movement.
But no, okay. Oh yeah, but the current state is if nothing else changes, I would
Right.
lose 31 in a day, and it changes
Right.
every day.
Right. Right. How accurate is that? Like, is that like going to happen?
No, it's all probability. It's all a
Right,
guess.
right. It only happens if nothing else changes.
Yeah,
If
which is
no
not
new,
realistic.
right, if no new demand comes onto the option, no demand comes out of the option, no, right, because Vega is,
The
we'll use that
volatility.
as a number, right? So your the difference between here and here is a combination of this and this. There's also interest rate involved and stuff like that, but that doesn't change very often. It's fairly constant, right?
Yeah.
But your primary difference here is a combination of theta and what they call Vega. That's how the model explains it, right? So I want to think of this. How does the model explain the difference between this and this? It explains it in theta and Vega, right? So theta is this theoretical curve that comes exponential curve that as you get closer to expiration, it increases. So what is all this? It's like there's this base number, like you don't know what it is, but there's this base number that says that if I have an option that is so many days to expiration and so many points from my asset price at this asset price, this is how much value this should have. But it has this much value. How do I explain this difference? Well, it's so many days to expiration. I have this theta number and this theta decay curve. That's going to be part of it. And then there's a percentage over that price that we're actually trading at. That's what this is. Okay, that's basically what's going on, right? How do I explain that this is more than what that my base number is? This is how I explain it, right?
Right.
It's got nothing really to do with theta necessarily, other than there's a predetermined number there. So that's basically what's going on with a single option. And again, when you get into complex options, it's just all the options together. Like if I add up It's like if I buy this option, this has this much theta and that much vega. And then if I sell this option, here, that has this much theta and this much vega, or in this much delta. And all it does is add them together. That's what I have. That's it.
Yeah.
And then if I do a
Okay.
butterfly, I'm just adding more options together. That's all I'm doing. Right? And that's your
All
analytical
right.
graph. Does you have any questions on that?
No, that makes a lot of sense now.
Right.
Well, thank you for that, because it's
it's
really
just
nice basic understanding. Yeah.
right. You can look at all the complex and theoretical stuff and get confused and never understand it, or you can just kind of dumb it down and just say, look, this is basically what's happening, right? And then you can really gain an understanding of what's going on. And then once you gain an understanding of what's going on, you can start to do things a lot easier.
And is that, sorry to interrupt, is that also why you said eventually you'd actually ignore the Greeks?
Yeah, I don't really pay a whole lot of attention to them. I'm just kind of looking at my T+0 line. I have a general understanding of why the T+0 line is where it is, right? So in other words, I have this position right here that is currently -9 delta, right? So that means if it goes up $1, theoretically you should lose $9. If it goes down $1, theoretically you should about $9 or $10. Theoretically you should gain about $9 or $10. I have a theta number, which we know theoretically, if nothing changes, I should gain value. Theoretically, over $83 by tomorrow. I have this Vega number, which is telling me if implied volatility changes by 1%, I should lose, $354, assuming the price doesn't move, right? Because my Vega here is different than my Vega here. Right? I have this little scale down here that if I come in and do this, I can see my Vega number up here is actually only -82. My Vega number down here actually goes positive, right? So I'm not always concerned about what my Vega is where I am. I'm more concerned a lot of times with what does my Vega look like where I'm going,
Mm-hmm.
right? Because the market isn't stagnant, and that's the other thing that a lot of traders get into is they look at this from a stagnant standpoint, where this is what it is, and I'm thinking, like, I'm not like if the market doesn't move, I'm not really concerned about my Vega because chances are it's going to go down, right?
Yeah.
Which means I'm going to get a better result in my 83 theta, because if I get 83 theta for the day passing and my volatility drops, then I make more than $83.
True.
Right?
And that particular strategy is aimed at a market that doesn't move much.
Yeah. I mean, it's a neutral strategy, right? It makes money when the market doesn't move much. But sometimes if I'm concerned about a move to here, sometimes I'm positive Vega there. And I can make this implication, right? So this goes to reading your T+0 line and kind of understanding what it might do. If I actually go to there and I'm positive Vega there, chances are the T+0 line is probably actually going to react better than it does now. You know what I mean? It's like not necessarily. It's not a. I don't have a Vega problem at that point.
Yeah.
I only have a Vega problem if volatility increases where I am now, which can happen, especially if you're like a stock with earnings, or if you're coming up on a Fed announcement. As we pull into the Fed announcement, what happens? Well, people think, oh, I think the market's going to move a lot because we're getting an announcement, and you can call that fear, you can call that opportunity seeking. I don't care, right? It's like people are buying options. People are buying options because they think the market's going to move. That's going to take your T+0 line and do what to? It's going to increase, because there's more money now, it's going to increase the Vega. And if it increases the Vega, it's going to push my T+0 line down. I don't care what this says, right? That's what's going to happen.
Yeah.
Right. So I'm aware of that. What does that present? Well, it presents a good buying opportunity. Like if I'm not in a position yet, maybe I want to get in it because I'm getting it at a discounted rate because volatility is up, and I'm net selling options.
So I get better prices when I sell them.
Right, you get better prices for your selling.
Yeah.
Right. Of course, you got this distance thing that's involved also. But if this relieves itself, like if I'm abnormally high in my Vega in my IV, and this T+0 line's pushed down, and that relieves itself, and I don't get much of a move, I mean, this is going to end up being up here, right? So that's good. But I do have a limit of movement that I can handle and have that be beneficial. That dynamic's still in play, right? Because if it ends up going here, then I'm screwed either. I don't care what the IV does. That's a problem, right? For me. So I have that dynamic going on. But most of the time, that can be contained, and it can be an opportunity to do that. But that might be why you're losing money, even though you're positive theta. Something's going on in the background that is concerning traders enough, whether it be from an opportunity standpoint or a fear standpoint, that they're buying a lot of options, and that's increasing your Vega, and that's pushing down this because it's negative Vega where you are. Right.
And that's when if I'm already in the position, then it's pushing it down.
Yeah. But the thing is, you should be aware of that before you buy the position. It's like one of the things that we'll do sometimes, or that we've talked about in the past, is what was this position worth at this price point 5 days ago?
Yeah.
And did it increase at $83 a day? Or did it lose money? Or did it increase at $500 a day? Right? Like if I put this position on, maybe the price was here, but I analyzed this position and my T+0 line said it was only going to be worth here, but now it's actually worth here. Then this is gained. It's just telling me that the position's gained a very large amount of value, more than it should have in the last 5 days. Right? And I can do that in backtester. Like I could put this on 5 days ago and see what it would have been worth today. And it's just telling me that the position gained a lot more money than it really probably should have theoretically. So something happened from a news perspective where people were probably long a lot of options, and now they've gone short options. And now the butterfly's priced more, like I'm probably paying on the high end for this. It's going to make the trade maybe a little bit more difficult, even if it stalls, right? So it kind of tells me something about the market sentiment that's going on right now.
Yeah.
Let me know if I'm losing you. I'll slow down. But
No, this makes sense. So it brings me to the question, but when you're looking at using one as a backtester to study and understand options and how they behave. So your point of attention are the T+0 line, how does that move? If I go forward a day and I go forward a day, what am I observing and what are my conclusions from my observation? So what is the learning I need to do in the backtesting one to get more understanding?
Part of it's like gaining the understanding that these numbers are like completely theoretical. The other thing is kind of understanding that this changes a lot. Like a lot of people don't pay attention to that. They just look at the P&L number, and they don't say, say in 4 days I'm here, right? And they just look at the P&L number when they're there. They don't go back and look at what the P&L number should have been if they got there. Okay. Right? Because that changed. And then it comes to, well, why did that change? And it's like every time the price goes here in 5 days, you're not going to get the same reaction. It's going to depend. It's going to depend on how the implied volatility shifted. It's going to depend on how close you are to expiration, right? Now, I don't always know why the implied volatility is shifting, but I should understand what the market sentiment is.